So that's the background between the fin and the tech. The question then becomes about disruption and how are we getting to, how is fintech disrupting what we're doing? There are three main areas that are causing disruption here. The first one really stems back to William Deming in the post-World War II Japan. The work that he did on efficiencies and trying to help the manufacturing process is ultimately what led to Toyota manufacturing principles, or is often known around the world, lean manufacturing. This is, you would be hard-pressed not to find a business that hasn't looked at lean manufacturing and lean processes in some way. And one of the best books to actually look at it is actually one of the people who were running the Toyota processes manufacturing plants is the Toyota way to lean leadership. It really gives that idea that when post-World War II, they didn't have the finances to compete with the big American marketplaces, the big American manufacturers. They weren't allowed to buy certain pieces of machinery because they were still seen as a threat post-World War II. And so they weren't able to compete in terms of size, they weren't able to compete in terms of money, but they wanted to try and get into this marketplace, and they were able to do so and beat the American car makers with very, very little resources. And it's the efficiencies. And you can see that disruption, that idea being echoed in fintech. We're a small, under-resourced player. The second part of the disruption is the idea of build, measure, and learn. And this is a specific circle that has come out of the Lean Startup by Eric Ries, and the book that preceded that, inspired Eric, is the 4 Steps to Epiphany by Steve Blank. The build, measure, learn cycle, the build, measure, learn, if you will, is about building something, whether it is actually software, whether it's mock-ups, whether it's something on paper, and measuring the impact it has had, whether it's going in with your hypothesis of what you expect to happen, measuring, working out what the difference is, and then learning from that and taking that through a very, very rapid iteration. And this is probably one of the iconic books that you that push not only the Lean Startup principles, but you will see echoed in rapid software development techniques such as Agile. The final part of the disruption is about putting the customer at the heart of things, and this idea of customer-centric thinking, or customer-centric design thinking. Design thinking has been around for quite a while, but the idea of bringing the customer to the heart of everything we do, rather than building a new credit card to make money, it's building a credit card to actually solve the problems and the painful points that real consumers have. There's a relatively recent book about this called Sprint, How to Solve Big Problems by Jig Now. This covers the design sprints that Google Ventures have been backing and have been running, and it is an excellent book that you can see where it has its roots in the Lean Startup and the roots in the Toyota way. But it's this disruption that it has caused these shockwaves. And what the fintech companies, what the disruptors are doing well, there's probably 6 key areas to this. Excuse me. And I will talk about the validated learning, speed of execution, and customer experience. But I'll talk about those 2 in another slide. So I wanted to go down to the lower half, which is the idea of getting insight from data. One of the big changes that fintech have brought with them, it's part of this disruption, is yes, we can build things efficiently, and yes, we've got we can learn from the data, but the data itself actually has business value. The customer analytics has a value. You can commercialize the value in you can commercialize the data you have and make money from it, as well as providing your core service. And for some companies, that allows them to provide a service to consumers for very little or free, and actually monetize the data separately. And it's the insight from that data that the institutional, the current players, the institutional, big institutions, don't really harness. And it's not for want of willing. Having spoken to all of the big banks, they all echo the same thing back to me, which is that they have trillions and trillions and trillions of rows of data, but they can't get access to it. One area of the bank is not connected to the other area of the bank. So while you may know an awful lot about me as a credit card customer, it may not be connected up to my current account. And I think a lot of people will realize that that frustration with banks of, you already have this information. Why are you not? Why is the mortgage part of your company not able to talk to the current account or the credit card? And most of the time, it's simply due to the siloed nature of the banks and not being able to have access to that wealth of data. That's something actually benefiting from that data is what the disruptors in fintech are doing very well. The fifth one on this list is opening things up to others, providing APIs and allowing extensibility of what they build, rather than saying this is a closed system or we are going to do everything and no one else is welcome. Having an API to allow other developers to connect, or other companies, or building your solution on top of another system by using their API and allowing that extensibility is a key part to making it to delivering more than the sum of your parts. Salesforce do this incredibly well in their CRM solution. They have an API where people are able to connect to, and they're able to build things that sit on top of Salesforce. And Salesforce has promised that for 2 years they won't copy what other people are doing. So that gives them developers the opportunity to go, great, I'm going to do this. I'm going to deliver in this market space, and I'm going to and I know that I've got the opportunity to stand on the top of the shoulders of giants. And it's okay. We're all trying to get the best solution. We're not directly competing. The last one on here is the hyper targeting of offers, and this is probably a critical part that links back to the data side of things. As an individual, customers of banks, customers of fintechs, pretty much want three things. They want to be understood. They want someone to understand me, and then they want someone to value them, and finally they want someone to help them achieve what they're actually going. And if you can understand me as an individual, as a unique person, and you can help me, then I will be loyal to you for a long, long time. But if you understand me and then try and offer me a generic solution or something that has just been handed out to tens of thousands, hundreds of thousands of other people without actually benefiting me, you have all this data, and it's using that data to bespoke something that is unique to me. And while it sounds a very, very complex thing to do, in terms of fintech, and the fintechs we'll look at in the second section, it's actually pretty easy to do when you benefit from the speed of execution and the insight and data. And it's those top three that I'm going to look at now. Many people will probably have seen this. This is the iconic imagery from Henrik Nyberg, and it was ultimately featured in user story mapping. This is trying to explain the difference between agile and waterfall. Waterfall on the top, to create minimum viable solutions. Most people will have heard of this as minimum viable product. A minimum viable product is, in general, a solution is you're trying to find a solution to a problem. You're not looking to build a product for a product's sake. You're looking to find a solution, hence the notion of a minimum viable solution. And if we scan across the top section of this image, if we spend 2 years to build a brand new bank or to build a brand new service for our customers, let's say a new online banking solution, and we in this instance the idea is I want to travel 50 miles and I've got some luggage with me. So the idea is, great, you've got a car, you need a car, and if I tried to give someone one wheel, they would be furious. 2 wheels and an axis, again, furious. The third step, a car with no steering wheel, and you have to wait for the 2 years and go, oh, great, okay, I've now got my solution. Well, I wanted to do that a long time ago. Yeah, that's not very helpful, but at least I can do it now. I can travel 50 miles with luggage. What's really interesting is when we look at the agile approach of this minimum viable solutions and building a walking skeleton, it's not only about the speed of execution, that on the first step on the bottom, something is in market, a skateboard, but it's also understanding what's working and getting validated learning and learning from our customers. So in the bottom instance, if you gave me a skateboard and said that this will help you travel 50 miles with luggage, I would not be impressed. That will not really, it's better than walking, granted, but that's not realistic. So I'd be pretty unhappy. If you had stepped it up to a scooter, okay, we're starting to get there. It's marginally better. The same with a bike. It's sort of half really getting there. What's interesting is with the bike, and my biggest concern is I need to go faster. I need to go faster to get there because it's just taking too long. And when you add an engine onto the bike, between steps 3 and steps 4, one of the things I'm noticing, and even back in step 2, is I'm enjoying the sensation of the wind rushing through my hair. I'm enjoying the freedom of having the wind blowing around me and feeling that I'm not encased. So taking those learnings on board and taking through into the 5th step, which would take about as long as the top process, is going, I'm not going to build you a car. I originally thought I was going to build you a car, but instead can have that sensation, and I can listen to customer feedback, and I can take that on board. And that idea of finding out what's working, listening to the customers, is why an iterative approach that takes these lean startup principles of the build, measure, learn delivers so much more effective, better solutions than an old school solution that big corporations, big pharma, and big banks do.